But we're not done with, exclusive conversations just yet. We had another one coming in with a market expert, Mixo Das, who is the Asia Equity Strategist at JPMorgan, joins us now from the sidelines of the JPMorgan India Investor Summit 2023 to get us some more, market talk. Mixo, thanks a lot for being with us on the channel. And this is a great time to be talking about how to approach global markets, right? Considering that it's a time when there's higher rates for longer, there are higher crude prices, there is foreign investor selling that has picked up in a market like India. Valuations are not looking that cheap anymore. How are you approaching India in the context of Asian equities?
Yeah, I think all the challenges that you outlined here, right, for the Indian market are really outside of India. And the biggest one right now is what's going to happen to U.S. equities, which really look quite fragile in the context of the next 2 to 3 months, given the rise that we've seen in bond yields and the bond volatility has been picking up. That typically tends to spill over into equity volatility. We've seen some of that in the last 2 or 3 days. And this could easily go on for several weeks to months, and we could see some downside in a global equity framework, and that would spill over into India and all markets globally. The other thing that's happening is that the dollar has been strengthening, and that typically tends to pressure emerging markets and Asian equities. India is slightly better off here because the dollar strength that we've seen so far this year has been mostly driven by rate differentials. And India stands out pretty well or okay on that front, so the pressure has been lesser. And the third thing that's been happening, and we think that will happen in the next couple of months, is that China seems to be recovering a bit. And so this flow rotation that you're seeing is in anticipation of that, where September is the first month we are seeing outflows from India since February. And we would expect that this continues in the near term as China recovers. Historically, the correlation between flows into China and India have been very negative. And so this sort of fluctuations is probably natural. The big picture thing, though, is that fluctuations are normal, and you have to live through volatility and periods of volatile markets. But the long-term outlook, as you can see in the JPMorgan India Summit, where we have over 600 investors across asset classes attending here, the outlook remains quite strong for the market.
So is that your base case, Mixo, that money moves out of India and into markets like China because of the rationale that you just mentioned? And is that the outcome expected over the next 1 to 2 years, perhaps? Or is that a more near-term outlook for you?
That's a very near-term outlook, I would say. So this is something that I would expect happening over the next 1 to 2 months rather than 1 to 2 years. I think on a 1 to 2 year time frame, you will still continue to get significant inflows into Indian market. In fact, even step back further from that, right? Is the ambition really to be the most preferred market, emerging market in 2023? I think that's kind of a given. India really needs to be thinking more bigger picture, more longer term, and try to improve its development across infrastructure, but also technology and markets and geopolitics. And all of that can happen. The opportunity set is definitely there. The setup is definitely there. So on a multi-year basis, I would think that there is a lot more capital to be coming into India. Keep in mind that the cost of capital, which has historically been a big hurdle for markets like India, has been coming down. This is partly a factor of the current account deficits going down. This is partly a factor of the more and more trade being done in INR. This is also reflected in India's inclusion in the JPMorgan Global Bond Index, which will bring some sticky inflows into the market as well. So put all of those things together, the capital challenge is incrementally being solved. So there's a lot more that can be done on a multi-year basis. When you think about markets, I would say that the biggest challenge for investors really is that there isn't enough stocks to buy. And I would expect that over the next few years, there will be a lot more capital activity. In fact, JPMorgan, even in 2023, has already been involved in 15 equity transactions. And there's a lot more companies that are thinking about IPOs in the next couple of years.
Absolutely. There's no debate that investing in the markets with a long-term perspective is generally the most prudent thing to do. But in the very near term, we have a big event upon us, right? There is, of course, the general elections coming up. And stock market investing ahead of general elections tends to be a bit tricky. In your assessment as a global investor or global strategist, how are you approaching this big event and what is the prognosis from an equity standpoint?
Right. So there's a couple of things to keep in mind, right? Like, first of all, if you look at the historical example, then it's actually quite positive, right? The Indian market tends to be up like approximately 13% in the 6 months heading into elections. So that's a good starting point. The second thing to keep in mind is that equity elections tend to be heading into election tends to be a good time in terms of fiscal policy expansion. And if you see more of that, then that should be actually positive for the consumer sectors. And the third thing is that the elections generally tend to be more of a volatility event if the outcome is extremely uncertain. I mean, we're still quite some distance away from the actual elections, but if it looks like the outcome is not going to be very uncertain, then markets can probably handle that sort of volatility.
Hi, Mixo. Good morning, Nigel on this side. Given that China's unlocking, the commodity space could do better. What's your thoughts on that front?
Yeah, we are already seeing quite a significant rally in the commodity space, right? Like particularly in the oils. And that's mostly so far a function of supply shortage. Demand from China has not really been very strong. And we don't expect that the stabilization in the economy in China that we are expecting, it's probably not going to be significantly led by investments and increased demand for commodities and metals. That having said, given where expectations were, you could probably see some support in the commodity space, and that will continue to drive commodity prices higher. But really, from a energy perspective, particularly, the bigger picture or the bigger structural upside driver is really on the supply side, where this combination of a lack of capital investments in these spaces has left the supply side quite lagging. And as demand slows down, but it's slowing down only gradually, supply is falling off faster, and that leads to an ever-expanding supply-demand gap.
On a valuation perspective, is there more headroom for the Indian markets? I know your outlook for the Indian markets in the medium term is quite strong because of the fundamental improvement, but how are the valuations stacked up now?
So if you look at a trend-adjusted forward PE, which is how we tend to look at market valuations, in India, it's about 21 to 22 times right now. And that's definitely on the higher end. It's about 1.5 standard deviations above its long-term average. But that doesn't necessarily mean that the market has to pull back from here. Keep in mind two things. That firstly, that this valuation is being supported by earnings growth. If anything, India's earnings growth, which looked like it was slowing down late last year, has reaccelerated this year. So if you look at the forward EPS in India, it's been turning up in the last 2 or 3 months. And if this trend continues, which we have a lot of reasons to think it should, then this earnings growth will kind of offset the valuation richness that you see. So on a price to earnings to growth basis, the market looks quite middling in terms of the valuations that you're receiving right now. The second point here is that if the market really delivers on long-term growth and if investors buy into that story, there's no reason that the market can't trade in the 30s and 40 times PEs, as we have historically seen some markets do when they become supermarket darlings. So there is no upside ceiling on the Indian equity market valuations at, say, 22 or 23 times. So that's something to keep in mind.
Before we let you go, just some thoughts on how to approach the Indian markets from a sectoral standpoint, because up until now, there has been a little bit of underperformance that the banks are seeing, especially some of these larger banks like HDFC Bank, could be because of bank-specific issues like the merger, impact, etc. But given everything, the two large pockets, banks and IT, which ones do you prefer with a 12-month horizon, and how are you approaching it sectorally now?
I think your conversation with Naren in the previous segment has a lot more material on that. But what I would say is that from our perspective, the banks and the financial space overall definitely looks the most attractive from a valuation perspective. The only issue is that investors are already massively overweight the banks. So this is something that you need to kind of balance out. So on a relative performance basis, we probably still would continue to prefer the bank space. IT is something that we've been a little bit cautious about given what was happening with ChatGPT and AI, but it increasingly looks like with investor conversations that many of these Indian IT firms may not be as big losers from the AI wave as it was previously being thought. So that space is relatively less preferred compared to the banks. But like I said, in a market that's going up on a 12-month basis, all sectors will probably end up higher.
All right, Mixo, thanks so much for stopping by and filling us in with your views on the Indian markets as well as global equities. Wishing you a good day ahead.